You wake up to a headline saying the economy is slowing. Markets are nervous. Analysts sound worried. But here's the uncomfortable truth. By the time those signals show up, the real behavior already changed months ago. The economy doesn't move when numbers change. Numbers change because people already moved. And that delay quietly shapes your job, your savings, and your future. Right now. Because we live in a world obsessed with signals. Inflation prints, GDP releases, interest rate decisions, consumer confidence indexes. They feel authoritative, scientific, precise, but they're all late, very late, and the danger is not that they're wrong. It's that we trust them as if they're early warnings. They're not. They're footprints. Let's start with why this matters right now. Over the past few years, people were told inflation was temporary. Then they were told it was sticky. Then they were told it was cooling. Each update came with charts, forecasts, and confident explanations. But everyday behavior didn't wait for permission. Households changed spending before inflation peaked. Companies froze hiring before layoffs showed up in data. Banks tightened lending before interest rates officially hit their highs. The system reacted first. The signals reported it later. That lag is not a bug. It's how modern finance works. And once you see it, you can't unsee it. So let's slow this down and strip away the jargon. Imagine a crowded movie theater. Someone smells smoke. They stand up. Then a few others notice and follow. Soon, people near the exits start leaving. The noise level changes. The movement changes. The behavior changes. Only after all of that does the fire alarm go off. The alarm didn't cause the panic. It documented it. Financial signals work the same way. They are alarms triggered by past behavior. Take inflation. Inflation data is published monthly, sometimes revised later, often averaged across huge populations. But prices don't change monthly. People change daily. When businesses sense uncertainty, they raise prices early. Not because costs already rose, but because they fear they might. When consumers feel pressure, they cut spending quietly. Before confidence surveys notice. Before GDP reflects it. By the time inflation prints hit the screen, the decision-making already happened. The number is the echo. Now here's where it gets uncomfortable. Markets know this. Professional investors don't wait for signals. They watch behavior, credit card usage, shipping volumes, job postings quietly removed, small changes in loan approval rates. These are not flashy headlines. They're subtle shifts, and they move first. Meanwhile, the public is told to wait for confirmation. This creates a strange imbalance. By the time most people feel safe reacting, the system has already moved on. Let's talk about interest rates. When a central bank raises rates, the announcement feels dramatic. Press conferences, breaking news banners, urgent commentary. But the real tightening often starts long before the hike. Banks pull back on lending early. Mortgage approvals slow quietly. Businesses delay expansion plans. Why? Because expectations move faster than policy. If everyone believes rates are going higher, behavior adjusts immediately. The official rate change just catches up. It's like slamming on the brakes after the car already slowed down. Now look at recessions. Almost every recession is officially declared after it starts. Sometimes long after. By the time economists confirm it, people already lost jobs. Companies already cut costs. Spending already dropped. The announcement doesn't change reality. It labels it. This is why recessions feel sudden but inevitable at the same time. The pain shows up first. The explanation comes later. And here's the quiet irony. Financial media treats signals like causes. Markets fell because inflation data came in hot. Stocks rallied after positive GDP numbers. That makes for a clean story. But it's backwards. Markets don't wait for permission from spreadsheets. They react to shifting human behavior. Fear, confidence, liquidity, risk tolerance. The data just tells the story after the fact. Let's expose the math behind the lag. Most economic indicators are aggregates. They average millions of actions across weeks or months. that smooths volatility, but it also delays truth. Imagine steering a ship using last week's position. You're not wrong. You're just late. And lateness in finance is costly. This is why hype cycles feel so absurd in hindsight. At the top, signals still look strong. Growth numbers are positive. Earnings appear healthy, but behavior underneath is already cracking. At the bottom, signals look terrifying. Negative headlines everywhere. Data screaming danger. But behavior is quietly stabilizing. That's why recoveries start when the news still feels awful. Signals lag both pain and healing. Now zoom out. This lag doesn't just confuse investors. It reshapes power. Large institutions can afford early signals. They buy alternative data. They watch behavior directly. Everyone else gets polished reports weeks later. That gap creates frustration. People feel like the system is rigged, like they're always late, like the rules keep changing. In a way, they are. Because the economy we're shown is not the economy that exists now. It's the economy that already happened. So what's the risk? The risk is mistaking confirmation for safety. Waiting for inflation to officially fall before adjusting. Waiting for recession headlines before preparing. Waiting for rate cuts before realizing conditions already shifted. By the time the signal feels clear, the opportunity is often gone. Or the damage already done. This doesn't mean ignore data. It means understand its role. Signals are mirrors, not headlights. They show where we've been, not where we're going. The uncomfortable part is this. The economy isn't driven by numbers. Numbers chase human behavior. And human behavior changes quietly, emotionally, and unevenly, before the charts catch up. So the next time a headline tells you what's happening to the economy, pause. Ask yourself one question. If this is the signal, what already happened before it appeared? Because the most important moves are usually invisible until they're over. And by then, the data is just telling a story you already lived.